Okay, so let's get right into it. The Federal Reserve is about to make a big move, and that has every investor asking the same question. If interest rates are going down, where on earth do you find a decent income stream? Today we're going to break down what the experts are saying you should do. You know, the article we're pulling from today kicks off with this classic Bob Dylan line, and for a really good reason. Because right now, there's absolutely no doubt which way the financial winds are blowing. And that shift, it's going to have a direct impact on your wallet.
Yep. This isn't just a guess or some fuzzy prediction. The market has already made up its mind, and the signal it's sending is crystal clear. Rate cuts are coming.
Now, normally you hear rate cuts and think, great, that's good for the economy. But the real question for you and me is, how does this actually affect us as individuals, as savers? Well, the answer is a little more complicated and honestly a lot more interesting than you might think.
So, first, let's just establish how much of a done deal this is. The market isn't just kind of hoping for rate cuts. It's treating them like they've already happened. Traders have already moved their money based on this expectation.
100%. I mean, think about that. You almost never see a 100% certainty in financial markets about anything. But that's exactly what traders are betting on. The debate isn't if the Fed is going to cut rates anymore. It's just by how much. That is a massive consensus.
And listen, this isn't just a one-and-done kind of thing. The market is pricing in a whole cycle of cuts. They're expecting 3 by the end of 2025 and as many as 6 by the end of 2026. The big takeaway here is that we are entering a new lower rate environment that's probably going to stick around for a few years.
So if we know rates are headed down, we have to ask who wins and maybe more importantly, who loses. The popular wisdom says lower rates are a win for everybody, but the data? Well, the data tells a very, very different story. Let's really dig into this. When the Fed cuts rates, it sends these ripples through the whole economy, but those ripples don't hit everyone the same way. There's one clear, undeniable winner in all of this, and I'm betting it's not who you think it is. Okay, this is where it gets wild. JP Morgan's chief global strategist ran the numbers, and they are just staggering. A 1% rate cut would pull $140 billion in interest income out of the pockets of regular households. In return, they'd only save about $30 billion on their own debts. So where does all that money go? The biggest borrower of all, Uncle Sam, gets a massive discount on its interest payments.
This quote just nails the feeling perfectly. For the last couple of years, it's been great for savers, right? You could park your cash in a money market fund or T-bills and get a fantastic, basically risk-free return. Well, that easy money era, it's fading out. The free lunch is over.
So if the free lunch is off the menu, it's time to start looking at the other options. This new world requires a totally different strategy. It means you have to actively go on the hunt for yield again, because the obvious, easy choices just aren't going to cut it anymore.
And that hunt, it's not going to be easy, because the market has already moved, bond prices are already high. That means corporate bonds are paying you very little extra for the risk you take on. Even the super safe municipal bonds are considered pretty expensive right now. It is a really tricky landscape to navigate.
But this is where smart investors can really find an edge. When all the mainstream options are crowded and overpriced, it pays to look in the corners of the market that other people might be ignoring. The source material points to a couple of really interesting areas worth a look.
So where are these pockets of opportunity? Well, the first place the article suggests is actually outside the US entirely. Emerging market bonds. They tend to play by a different set of rules in an environment like this. So why look there? 3 big reasons. First off, you just get higher yields. Simple as that. Second, there's a potential currency boost. See, when the Fed cuts rates, the US dollar tends to weaken. That makes your investment in a foreign currency worth more when you bring it back home. And third, it's just smart diversification. Okay, on to another idea, this one a little closer to home. The article shines a light on what it calls a perennially neglected corner of the market, closed-end funds that invest in municipal bonds.
The article gives a couple of specific examples, like the ones you see here. Now, what makes these interesting are 2 key things. First, they have these attractive yields, which are often tax-free. But the real secret sauce is that they can trade at a discount to their net asset value, or NAV. Just think of NAV as the real, true price of all the bonds the fund holds. A discount means you're literally buying those bonds on sale, like getting them for 94 cents on the dollar. Okay, so we've gone through the problem, and we've explored a couple of really interesting potential solutions. So let's try to boil all this down into a clear strategy for this new hunt for yield. It all really comes down to a 3-step game plan. First, you've got to accept that the game has changed.
Relying on cash for your income just isn't the winning play anymore. Second, don't go chasing crazy, risky yields. Stick to quality assets. And third, you have to be willing to look beyond the usual suspects to find those pockets of opportunity we've been talking about.
And really, that's the big question this all leaves us with. That easy money environment is ending. So it's time for all of us investors to get a little more creative, a little more strategic. This isn't about panicking, not at all. It's about being prepared and proactively adjusting your game plan for the road ahead.